So first and foremost, understand who you're dealing with,
Mhm.
understand you're a vendor, and if you're really ready to grow, you should ask your ISO for some financial help. Easiest and the friendliest way of capital.
Well, we have a very special podcast episode for you today. I was able to get a panel together with some of my friends. Vlad Sadovsky from Nativia just did a big capital raise that he'll talk about. Michael Peters, who's been now an advisor to different entrepreneurs in the industry.
Right.
Alex Renzi, who's from MAP Advisors and helps to put these deals together. So we're talking about raising capital. So very, very interesting. It's very practical, very insightful with panel discussion.
Right.
Then we move on from that to the insiders. And tell us about that today, Patty.
Well, about the summer's vacation time, and what are some of the spending habits of consumers out there?
Also want to mention that in this particular episode, we do interview Vlad from Nativia, and Nativia is the sponsor of our podcast. We certainly want to
Right.
mention that. Michael and Alex, not sponsors or anything of that nature. And of course, this episode is also sponsored by Nativia, so we'll hear from Vlad a little bit later on in the episode. But with all that being said, let's dive into this really awesome panel discussion. Get ready to take some notes. You may even want to pull over as you listen to this one. There's a lot of really practical insights if you're looking to grow your business and raise capital in the process.
Yeah, I think it's going to be a great one. Thanks, James.
Hey, everybody, we have got a fantastic panel for you today. Today, we're talking about a topic that's on the mind of every ISO out there that's growing their business, and that is how do you raise capital for growth? And so we've got Alex from MAP Advisors, we got Michael Peters on here, and we have Vlad Sadovsky. And so we're going to be talking about, hey, whatever stage you're at in your evolution of, building your payments company, how do you get outside capital, especially in this particular economic situation? So what I want to do first off, gentlemen, is just have you each introduce yourself. Vlad, I want to start with you because I know we had this recent capital raise that I'm sure people have already heard about. But for those that maybe haven't, can you walk us through a little bit of your own experience in raising capital, which is kind of very recent, and talk a little bit about that situation before we dive into the discussion?
Yes, thanks, James. So first of all, raising capital today, you have to be a real company with the real numbers and preferably profitability. If you're spreadsheet pie in the sky scenarios or spreadsheet scenarios only, it's not easy to raise capital if you're an established business. All the fintech valuations are down from 2 years ago, and I think that the process is going to continue for the next couple of years. So the monies are available, but to the companies that really produce profits and not only have a path to profitability, but actually are profitable. So that's number one thing. Number two is you have to have a good business plan for expansion. Depending on how much money you looking to raise, you have to be able to provide a solid foundation of what is that going to mean for a lender to give you money and how that's going to propel your business. And what are the pitfalls you can account along the way in doing that? Not just to, raise capital and then you're going to go buy a house for yourself or a fancy car, which
Right.
a lot of people do, especially in the agent community. The minute they raise capital through a portfolio sale or otherwise,
Right.
the first thing they do is they go out there and buy a fancy car and a better house, which is not a bad thing to have, but you also need to get some money to your partner, which is your business.
Right. Right. Yeah, good stuff. And so can you share a little bit with us about the capital raise you guys, I know you just finished a process, right? Just closed recently.
Yeah. So the process we went through was very, very tedious. Lots of questions, lots of twists and turns. We specifically raised an acquisition capital, so it was a debt raise for the most part, because I don't believe that the valuation of the companies right now are good enough to raise any equity capital. Plus, we didn't need any equity capital. I think that if you look at the space today, especially with the latest deals where Payrock and Priority out of the ones that were worth mentioning that raised a substantial amount of money, and they were able to accomplish deals, large deals, with debt. And I think that it's a good way to grow without discussing the valuations
Sure.
just yet.
Love it. Awesome. Good stuff. So Michael, let's go up to you and maybe you could share with our audience. I know you've been on the podcast before as well, but give us the quick version of kind of who you are and what you've done in this space.
Thanks, James. Yeah, Mike Peters. I've been around in the industry for close to 40 years now. Most recently, exited as the CEO and president for Get Beyond. We were successful in completing a transaction to Global Payments at the end of last year. My background spans mainly sales acquisition, sales operations, and about 6 or 7 years ago, sort of found my way into the CEO role, helping TSYS run the merchant segment, and then ultimately stepping in as the CEO at Get Beyond.
Awesome. Love it. And then we also have Alex on here today from Map Advisors. Alex, I think we're like panel buddies or something. We've been on several of these now, right? So tell us a little bit
Making
about
the rounds.
yeah, tell us about who you are and what you do for our audience that may not be familiar.
Sure. Thanks for having me back on, James. So I'm a managing partner at Map Advisors. We are a fintech and software advisory firm. We essentially help companies of all sizes plan and execute on their capital and M&A strategies. So before Map, I was on the founding side of payments companies where raised capital, bought and sold companies, which I think gives me a unique vantage point to advise with empathy, knowing, what my clients are going through.
Sure. I love it. Okay, so we're going to jump into this panel discussion today. So again, this is all about growth and raising capital to fund that growth. So Vlad, let's go back over to you here and let's talk about the challenges. So you know a lot of ISOs in the space. You have a lot of ISOs that use your BIN program and things like that. For those that are like, wow, we want to raise capital to grow, what are the big challenges that they're facing in today's economic situation?
Well, first of all, the evaluation of portfolios, right? So you need to have realistic expectations of your attrition within the portfolio and how open you are to the potential fines from Visa on your cash discount business and how big the cash discount business is sitting within your portfolio. It's very clear that it's one area that at this point, for the time being, you're going to get discounted in your valuation. The second portion of the valuation is that if you are strictly high risk ISO and you don't have another balance on a portfolio level valuation, you will get discounted there as well. And then the third piece of the puzzle is how good is your sales channel and whether you are having technology and stickiness within your product set, or you're only selling terminals and you're selling mom and pop merchants like you normally were, 10, 15 years ago. So those things first come in a portfolio evaluation, because that's essentially is the asset that any agent or any mid-size ISO is going to get valued at. Second piece is, of course, when you are going to a larger level, and let's say you're an ISO with 10,000 plus merchants, and you're trying to get not portfolio but a business level valuation, is a very simple question. What's your portfolio growth versus your attrition growth? How much you're losing versus how much you're making? And for somebody to invest in you, you got to have a realistic expectation that the deal should not go bad. The deal should be successful for both parties. People that are putting money out, they're really, really looking for a return, maybe 2-3 times over the course of the next 2-3 years. So if you feel like you're not positioning your business for somebody to come in and enjoy that 2-3 times with you and rely on you if you're doing a partial sale, or rely on your management team if you're doing a full sale, then you have the wrong expectations. People are no longer looking for the next Google or Facebook. They're very, very cautious because they don't know what to expect from the economy. Plus, the money's extremely, extremely expensive with high interest rates.
Right. So Michael, if we, kind of having that context, right? What do you see ISOs and processors, what mistakes are they making, right, that are keeping them from being able to raise that capital?
That's actually a great question. I'll tell you this, James. I have spent my entire career in this business around the sales side of the business with ISOs. And one thing that they're extremely good at, especially when they splinter off and they fracture off from big companies or larger ISOs, they can sell. Sometimes they get out ahead of their skis, and here's where they get in trouble. Their expenses, building large infrastructures, wanting to be everything to everybody in the industry. And next thing you know, you look down, you have a couple of bad sales months. You start to look at expense lines, infrastructure, and say, how come we're not profitable? How come we're not making money? And it catches up with them quickly. I've experienced it firsthand. I've seen it firsthand where sales is not necessarily always going to fix how you spend. So, as I used to tell my kids before the dinner table, don't let your eyes get bigger than your stomach. And it's good advice for any ISO that's starting up or is in the throes of looking for financing. Is, as Vlad said earlier, make sure you know your numbers. Make sure you have the proper expectations from a sales perspective, and don't oversell your business to a prospective investor. Give them the facts, give them the true numbers, and they'll appreciate that going in, because a bloated balance sheet and P&L against a sales balance sheet that's not is it's going to be a struggle for somebody.
I love it. So Alex, then the natural next question here is, what should they be doing? So Mike kind of alluded to some of that, but what are the top maybe 2 or 3 things that you see where you're like, yeah, this is what you should be focusing on if you want to build a solid organization that can raise capital?
Yeah, I mean, I think it's challenging to narrow it down to just a couple, because it's obviously
Sure.
different for every organization. And that said, I think a lot of leaders will make the mistake in the fundraising process of diving right away into the facts and the figures, which are the rational things that make up your business. And while that is what will make or break you during investment committee, I don't think that's where you need to start when presenting your company. I think you need to start with the story, right? Investors are people. People respond to storytelling. The story needs to show where your company came from, where it is today, and why the next round of funding is really going to accomplish the very reason that you're raising capital. So for instance, if you're raising money to, take secondary chips off the table, your story needs to center around the historical and the future stability of the business. If you're a pre-revenue company and your ambitions are to be the next unicorn, your story needs to be about growth and how big of a market you're going after. So I think starting with the story is really important. When it comes to, practical advice, do an internal audit before you go to market, right? And when I say internal audit, I mean really focus on financial and legal audits. There are so many ISOs, especially at the FSP level, that they run into trouble when investors bring in third-party auditors from the accounting standpoint that don't know payments, and they say, okay, let's look at your residual mid-level data, and why isn't it matching the P&L? That's a nightmare, right? Every payments company goes through it. They need to be prepared for those questions, because the more confident you are in the responses, it goes back into the story of knowing your numbers and knowing what kind of company you are. So I think that's really important. And then on the legal side, a lot of ISOs, to Mike's point, are sales organizations, right? So
Right.
just make sure that all of your agreements, vendor relationships, downstreams, everything's documented and doing what it says it's doing, right? And when I say documented, even signed by both parties, right? It sounds very simple, but you lose track over time of these things. So make sure it's documented, make sure it represents what it's being said. And if not, get an amendment, right? It's a very quick fix, but the more of these things you have in a row, the much more simple the process will be.
I love it. So Vlad, let's circle back to you. And this is kind of a 2-part question here. So again, we're kind of keep broadening the context a little bit. So now let's zoom in a little bit more. So we've talked about kind of mistakes and opportunities and challenges with raising capital, but what I'd love to talk about now is like sources of capital. So 2 things. One is sources, and you touched on this earlier: equity versus debt. Where do you go to find capital depending on where you're at in this kind of growth continuum? But then also, who do you partner with? How do you think about this as far as like, okay, I need some other people to help me make sure I'm making the right decision. I've got the right connections. We're putting the deal together correctly. So talk a little about kind of more the mechanics of that process.
So, interestingly enough, I used financing arrangements for the companies that I was part of prior. And obviously, this time around, we just raised a significant amount of capital. And at different levels. I mean, I remember my first loan of $100,000 from Bank of New York. And my father was, my bookkeeper and my accountant at the time. And when that first $100,000 hit, he couldn't believe his eyes that it actually happened. And it was not against the mortgage, and it was not against anything else. It was actually against the business. So it's not easy to validate your business to a point where somebody gives you a loan not against you or your
Right.
other assets, but against the business. So first and foremost is getting there, is probably number one validation of that you're on the right path. And it doesn't matter whether it's $100,000 or $1 million. I mean, I've had $1 million fundings, and now with this is a tens of $1 million fundings raises, and it doesn't hit me as much as it hit me that $100,000 back in the days. So I think it's very, very, very important that you understand that your business is fundable. Now, in our business, unfortunately, residuals by traditional banks is not something that they understand very easily.
Right.
And so it might not be a fundable business from the bank's perspective. However, there's specialty lenders, and there's obviously ISOs and processors that are very, very, I would call it advanced loan friendly. I consider myself a very advanced loan friendly. We have separate divisions, separate companies that we've created, and I've had it in my previous companies for years, where we advance our ISOs money either through a third party or through special vehicles. But the bottom line of it is, we understand that every ISO grow, every successful ISO we have today on our books have taken money from us one way or the other. And so not only I'm thankful for getting financed myself with great financial partners over the years, but I've also tried to do the same for my ISOs. And so I encourage them to do that for their agents as well. So all the way down to the downline. So first and foremost, understand who you're dealing with, understand you're a vendor. And if you're really ready to grow, you should ask your ISO for some financial help. It's probably the best and the friendliest source of capital. They already process your residuals. They know what to expect of you. They will be expecting more because now
Right.
it's not at your pace, it's their pace, because they want to have the collateral grow. But still, easiest and the friendliest way of capital. The second option is, of course, friends and family. But there you are really touching your personal life, and I don't suggest it. I tried it before, I did it. I'm not going to say I didn't do it, but I don't think that this is a validation of a business.
Right.
It's a more of a, hey, we're here to help you, we're family type of thing.
Right.
And as you grow, if you get to a certain level, then educating your local bank or educating a specialty lender, it's always actually better, because if you have an independent lender, they're more independent, they're more interested in your business. If you have multiple portfolios, it's a much more sustainable situation. Obviously, let's say one of my ISOs comes to me, I want all the business to Nativia. It's pretty
Right.
obvious, right?
Sure.
An independent lender might charge you, different rates than the processor lender, but we'll probably give you an opportunity to have multiple portfolios if you desire to do so. However, my position is, somebody gives you money and you want to grow with people that want to invest in you, because now they're responsible just as much as you are.
Right.
If an independent lender, they're more responsible across the board, you have a little bit more flexibility, but what does it say about your processor at that time?
Right.
That means that your processor doesn't want to invest in you, or doesn't they don't feel like you're worth investing. So I think that's a good question to ask yourself for when you're looking at source of capital. And then of course, if you have good credit and you have an ability to get a business loan from a bank, it's the cheapest money you're gonna get.
Right.
Finally, if you position your business more on the fintech side, or you position your business as more of a SaaS play, or you partner with a company for a SaaS play, then you can really go for, those Series A, seed round, Series B round, depending on the size you are. And that's, of course, probably the absolutely cheapest capital you can possibly get. And especially on the seed money and Series A money, because there's a lot more seed money available. People still have money to invest. Entrepreneurs have the money to invest. Funds have the money to invest, but they want to see either a proven player or a solid business plan to be able to invest into you, and they are expecting a very, very big returns if it's your seed round. Don't think that you're gonna wow somebody with 30% return when somebody takes the biggest risk investing in your company at the valuation you desire, without any payment back. It's not Silicon Valley. We're not Stripe. We're not Square. You know,
Right.
we make money the same way, but we're not them.
Right.
So we really need to show a good sales plan for the most
Yeah.
part, and partnering with ISV plan, or partnering with a POS company plan to get comfort around, a large valuation of your business beyond your portfolio value.
Yeah, I have to go back for 1 second. You're talking about your $100,000, your first one. As you were saying that, I was thinking about, so I just got into the business, maybe like 4 or 5 months, really broke, and this is probably 15 years ago. I got this like email from my payment processor, and it was a really clever ploy to like get you to sell your residuals at like, I think it was like a 13 or 14x or something like this, but I will never forget it because it was like $5,400. Like, hey, we will buy your residuals. I just started, you know what I mean? And I just switched this company, and it was like 2 months in or 3 months in. And I got this email, and it like, this light bulb went off like, wait a second. These portfolios are worth something, like, this is an asset. And it was like, yeah. So you never forget that, when the kind of light bulb comes on, that was huge. So
Yeah, but by the way, before any loan deals that that I've gone through multiple times, and we separate, selling a portfolio is not a bad thing if you
Right.
can regrow it.
Right.
And on the salesman's level, look, if you have a $3,000 portfolio, selling that and understanding that you could buy it back by implementing a very aggressive sales strategy
Right.
is not a bad thing. If you feel
Yep.
like you can grow another 5,000, if you loan against it, it's a payment anyway, so it doesn't
Right.
really make a difference. But you'll
Yep.
get a very high multiple compared to a loan, and that will propel you further.
I've done it, I think 4 times, over the career of like, I'd build something, and then you sell it and build the next thing, and you sell that and build the next thing. So a very proven path in the industry for sure. So, all right. So Mike, let's go back to you and give us some pros and cons of really different sources of capital. So when you're advising ISOs looking to raise capital, how do you kind of, lead them or advise them and like, hey, here's where you should go versus go in this direction?
And, listen, Vlad touched on a little bit of this. So obviously, angels, investors, friends, and family, they're not going to know a lot about your business. It's going to be a limited amount of resource. You're only going to go to that well so many times.
Right.
And ultimately, what happens there is that's early stage typically. You're going to have to go somewhere else for money afterwards. And then they're going to want to know how they're getting repaid back. So they're not necessarily in your business as much, but there's a lot of emotion that goes along with that. So I don't necessarily advise anybody to go that route unless they have a rich Dutch uncle someplace and they and they don't mind tapping Uncle Ben there for a big check or something like that. Strategic investors, and I put those in the the super ISOs, even the global payments and the EVOs and the Elevons of the world. Those organizations will invest in your business, not necessarily just from a buying of a residual, but invest in your business because they think you might have some technology. You've got a great sales engine. You've got a great story to tell. But now their sight is on ultimately probably acquiring your whole business at some point in time. So that is the start of an exit strategy. And if that's what you want to do as an ISO, and that's where you want to be in 3 or 4 years, as you all have said, you've done it 3 or 4 times yourself. That's not a bad plan. And then obviously there's the PE backed investors where listen, they're in it for a buck, and they're going to want to know deeply what you're doing, what your plan is. You're going to sit down at a quarterly board meeting, and they're going to want to have a say in the business, whether they know the industry or not. And they're going to get in your shorts. And you really can't be in a position where you're going to buffalo them too long. It's going to be, all right, you told us X when we wrote you this check, and you said by this date be at Y. You're 15 letters off of that. So where do you see headway? So I don't think there's any one right answer for going out for capital. Vlad touched on it. It's the first $100,000 you got to going out for millions of dollars. There's an expectation. People are not giving you the money just for being a good guy or a good gal. They're giving it to you because they want a return on their investment. And some have less patience. And the last piece of advice I would tell anybody is if you're going to get in bed with somebody and they're going to advance you capital, make sure that you are strategically aligned with what they want to do, and that you're walking with this thing eyes wide open. Because behind the scenes, after the check's written and the money's spent, there's no going back, and they're going to want to see a return on the investment.
I love it. Yeah, definitely a level of transparency. You know, it's not if you don't want to trick somebody into giving you money. That's not a good idea.
We went through it with Get Beyond. You know, we went out and tried to raise capital before we sold the company, and we were very transparent with everybody. And to Vlad's point, very hard to raise capital when you're not cash positive every single month, and it makes the job even that much more difficult. So.
Good stuff. So Alex, let's dig even deeper into this. What are the kind of operational realities or implications when you're advising ISOs and payments companies in terms of if you choose this form of this source of capital versus another, and what are some of the key differences there they need to be aware of?
Yeah, I mean, I think it's, really important to recognize first the kind of company you are, so you aren't wasting time pitching to investors who don't fit your business model, right? Going
Sure.
back to the other, sort of extreme example, if you're pre-revenue and burning a lot of cash, don't approach private equity, right?
Right.
I think practically speaking, you have the debt and the equity providers, right? So debt providers are more concerned about downside protection and making sure that they get repaid. That's because they don't get to share in your upside. Whether you're worth $10 million or $100 million, their rate is their rate. So practically speaking, they want to make sure you have a sound business plan, you have good financial controls, they're not going to get burned. Equity investors, while they do care about downside, they want to make sure that they're investing in your business is the best thing that they can do with their most scarce resources, which is, time and money. So that's where the vision, the storytelling really takes front and center. And you have to be confident in your forecast and your execution plan to hit that. So that's kind of the big distinctions.
I love it. So, all right, as we transition to kind of one final topic here, I want to go around the group a bit with this. So, Vlad, I want to go back to you. This is something I'm really passionate about, and you know this from our conversations. But there's a lot of, I think, maybe feeling, especially in younger entrepreneurs I talk to, where if they're able to raise capital, right, it's like they won. Like, yay, let's throw a party. Somebody just wrote us a check, rather than maybe a feeling of, wow, like like someone just invested with an expectation. Now we have to execute. So what is your mindset? You just raised a bunch of capital. What's your mindset of, okay, we raised capital. Where does your head go to the next day? Right.
Well, first of all, my head went to partying. I'm not different from anybody.
Right.
We actually, timed the transaction in the beginning of the month, and you and I both know, James, Nativa took a front seat and center to the Panthers game, and
Right.
in Florida, and nobody betted on them winning the Stanley Cup, and we did. And so around the same time, we got funded. So it was kind of a very interesting scenario.
Yeah.
And the parallel to that, and especially given the fact that Panthers went all the way to the game 7 to win the cup. We also had our twists and turns to win the cup.
I love it.
But so it's a lot of relief, especially if you're raising a lot of money. It's a lot of relief for the team. So you have to give them some of that time to feel the fact that their hard work has actually achieved the result. So it's more of a result achievement party, not a spending spree party, right?
Right. Yeah. Recognition, right?
Right. Recognition. Correct. That's probably the best way to look at it. But after that, I mean, you have to be conscientious of the fact that, well, now you have to execute, and then you agree to certain numbers, you agree to certain ratios. I mean, I've raised capital based on portfolios. I've raised capital based on a public company. I've raised capital based on the private company that the Nativa is today. Every time it's a different expectation. But there's always an audience that says, well, you said that, as Mike rightfully pointed out. So if you are a small ISO, most likely you got funded based on your portfolio. So you got to stay within the ratio. If you're a liability ISO, you might take a hit. Make sure that you have reserves in to hit. Like, actually start doing more work. Some people actually would do this, money, and then they just start spending bigger offices, more people. I mean, it's all there. It's necessary beast, and you want to feel bigger than life at that time, especially within the first 30 days. But you also have to realize that look, the party is going to end at the next curve of the economy. So if you
Right.
don't keep economy in mind, where you're going to be, and take advice from people that are already there along with you, advisory board people is probably your best investment. Get people on board that been there.
Mm.
One thing
Yeah.
that I do for Nativia ISOs, and especially when we give out money through our Nativia lending vehicles like Nativia Financial and the banking vehicle, we advise, like literally advise, to a point of, I will drive around with you if I have to, go to your city and help you pick a space. Because a lot of times people are great salespeople, trying to go from a salesperson to an office becomes a hurdle that people overspend very, very easily.
Yeah.
Going from one level to the next level, same story. You feel like you have all the power in the world. Well, it's borrowed power if you're doing borrowing. If you're doing a capital raise, then this money is going to end. So
Yeah.
what are you going to do when that money ends and your revenue is not going to be there? Before, all the fintechs would say, "Oh, we just raised this much capital. We just raised $10 million worth of capital, and this is our burn rate." Well, in our business, there's no such thing as a burn rate. What are we burning on? Getting an account? Okay. If you're burning as a software company and you need to develop certain technology, understand that if you don't convert that technology into sales, that technology is going to die within the next couple of years very, very quickly.
Right.
Because you're going to have your developers come to you and say, by the way, there's this new technology that just came out, and now we have to rewrite the entire code.
Right.
Or now we have to do our next version of an app, and then before you know it, you're spending the same amount of money you spend initially,
Right.
which is why you raise your capital. So if you have a very limited time to produce results, and getting people that will help you produce those results by having an advisor, somebody looking from the outside that's been there before, or at least have an idea, is the probably number one priority as soon as you raised any type of money. It doesn't matter what it is.
Love it. It's great. Mike, going to you on this. You know, there's a reality. I watched a really interesting video from, I can't remember the name of the guy. Was it Schultz? I think the guy that founded Starbucks, right? Is it named Schultz?
Yeah.
Really interesting video. He was talking about, for entrepreneurs that are concerned about raising equity or raising debt and losing control of their business. And he was talking about how ultimately results are the key to whether or not you're going to maintain control. Like whether you own 5% or what, it's like, unless you own a controlling interest with contracts that allow you to fully control it, at the end of the day, when you take on capital of any amount, your results against your plan are what's going to determine your level of freedom and operation. What have you found along those lines, and what kind of tips do you have for the executives out there that, they're raising capital and they don't want to get themselves stuck in a bad situation?
Best piece of advice I can give, and I'm experiencing this now because this last year or so I've been consulting and working with entrepreneurs. Separate reality from vision. It's great to have a vision, but you better have some reality behind that and what's driving the vision and the plan. Make sure your sales plan is solid. Make sure it's repeatable. Make sure it is to a point where you've got it down to a science. Yes, you're going to have some ups and downs, and you'll have a bad month or a bad quarter, but there's a recovery period, and you have to plan for those things. Any investor is going to look beyond the fluff, and they're going to dive into the numbers, as Alex said, and if you don't have a command on your numbers and know exactly where you're headed from a sales perspective, they're going to read right through it, at least sophisticated ones. Angel investors, probably not. You're probably gonna get a pass there. But anybody that has any level of sophistication around investing in the business, they're going to they're going to drill into that aspect of it. The mistake that I have experienced with an entrepreneur was that the vision was sales is going to fix everything. Well, that's not necessarily the case. Yes, they're very good at sales, but when you start to overspend, like Vlad was just discussing, or you start to go out, you put 2 offices in places where you didn't really need 2 offices. You go out and forget the individual purchases of the houses and boats, but you just start investing in the business. You know, do you really need a chief operating officer? Do you need 3 legal counsel? Do you need all of what you think your empire needs? And operating lean is the best advice I can give somebody, and making sure that you have command of that. If you continue to make those same mistakes, what happens is you're a year, 18 months into this, 2 years into it, you look down at a sheet of paper and say, how did we miss? Our sales, we're doing 500 accounts a month, we're doing 1,000 accounts a month, our revenue's good, but we just can't seem to get ahead of the pace. Well, it's because you spent it all out the back door and you can't bring it in fast enough. You can't outpace the bad news.
Wow. Yeah, I love it. It's kind of a common theme throughout here, right? Is that you know, you can't outsell your spending, right? So, yeah, good stuff. Well, this has been fantastic. Alex, I'd love for you to kind of close us out here and tell everybody kind of what, you know, I think a lot of the ISOs out there, the information they're looking for is like, what is the current state of the market? Where do you see things going in terms of like availability of capital? And so gaze into your crystal ball that of course you don't have, and give us your thoughts on kind of where we're headed with all of this.
Yeah, right before an election cycle with 2 candidates with very different fiscal and regulatory policies. Sure.
Right.
Yeah,
Right.
that'll be an easy guess. No, I mean, I'll start with the obvious, right? The economy has weakened, right? We had a very long period of little to no interest rates coupled with massive government stimulus. So we just went through an aggressive rate hike from 0 to 5% interest. This creates pressure on companies to be profitable. So while there's still a large amount of capital available to be spent or invested, I think investors continue to focus on the fundamentals, growth and profitability. So when it comes to asset classes, you know, I think it's been really positive to see the US IPO markets having their best start in a long time. And the overall stock market is, you know, doing pretty well, although, you know, some could argue it's propped up by AI. The asset class that we've seen, you know, grow the most has been in private credit. We think this is a tremendous source of capital for payments companies, but you have to take the time to educate the lenders on a residual stream being an asset that you can lend against. So I think you're going to see a lot more of these announcements coming out in the future. Venture capital has cooled quite a bit in payments. We've seen a lot of problems on the issuing side with banks getting regulatory, you know, orders, cease and desist, et cetera. And then we've seen struggle on the acquiring side with, you know, PayFac struggling to gain traction. I think on a cheery note, private equity still has a lot of money. There's a lot of groups out there with payments experience looking for a platform. And I think their interest in more traditional ISO market is going to be reinvigorated, given they can see the resiliencies and the cash flows and the positive growth of this asset class for a while. So I think if you're a payments ISO, I think you're in a good position. You have capital available both on the debt and the equity side, but make sure you do your homework on who you're partnering with and make sure you have all your ducks in a row before approaching the market.
Excellent advice. Well, I want to take a minute to just thank all of you for taking your time out of your very busy schedules. So thank you, Alex, Vlad, and Mike for jumping on and educating the industry. I'm sure everybody got some good insights out of that. So thank you all again for your time today. I appreciate it. Hey, everybody, I'm here with my friend Vlad Sadowski from the TVA. We're talking about the MWAA. This year, I am actually attending the MWAA. I guess I was there last year as well, but I'm going to be there this year doing a panel. Excited about that on Thursday afternoon, talking about embedded finance and B2B. And of course, Vlad and Team Nativia will be there putting on exclusive events for, you know, professional card holders and all that. So Vlad, tell us about what you have going on with the MWAA this year.
Well, as always, we're going to have a fantastic, fantastic party. Last year, we did a speakeasy party. This year, you're going to hear an announcement. My team actually asked me not to announce it online. So watch out for your emails from MWA. And if you're on the list and if you're a card member, we have 2 types of experiences. our full party experience and then our card member full party experience. That will be slightly different from the experience that we will be providing for our future card members, hopefully. But as always, we're going to try to, exceed the mark of last year and make sure that everybody having a good time at our party at the WMAA.
Awesome. So I will be there.
MWAA.
Yeah, MWAA. I'll be there at the panel discussion, and then I usually kind of come in and come out for these panel things, but I will be at Vlad's party. So if you want to hang out with me and talk to me, definitely head over to Vlad's party. So be looking out for those emails. And if you're not already a card holder, don't forget to head over to nativia.com/professional. That's nativia.com/professional. Thanks, Vlad.
Thank you.
Well, James, travel and tourism spending has been increasing, inching its way back to pre-pandemic levels over the past few years, according to a new report from the Straw Hacker Group and Discover.
Okay.
They say demand for travel is strong and travel spending is expected to reach record highs in 2024. I wanted to bring this up because we're at the beginning of summer, and, give people a feel for what's going on. Not surprisingly, those who make over 100K annually plan to spend almost 3 times as much on average than those that make less than 100K, 15,000 versus 5,000. Younger consumers, namely millennials, are the generation most likely to travel in 2024, and those with young families are most likely to travel. Globally, though, North Americans are less likely to travel. Now, I'm going to just give a personal anecdote here. I have a friend whose son took his family on the vacation of a lifetime.
Yeah.
They traveled the whole Pacific, started in Japan and went all the way down to Australia, touching all the islands.
Sure.
That's a pretty, and they're millennials. That was a pretty
significant vacation.
trip.
They probably use their card a fair bit along the way.
Oh, I'm sure a fair bit of it along the way. So sports is a huge draw for travelers, and sales of sports tourism packages is expected to grow 15% over last year. Can't help but think the Olympics probably have something to do with that.
Sure.
Beach tourism, as always, is also big. But there are some inefficiencies that threaten to stem spending if not addressed. For example, consumers now see payments as a critical part of their travel experiences. So what are the concerns? They want more payment options. Credit cards, of course, are king for North American travelers, and they really like airline branded cards that allow them to earn discounts on flights. But there is a slight preference for use in debit once they are at their destinations.
Huh. Okay.
Yeah, I thought that was really interesting. And in part, it's debit going to the ATMs, but it's also debit at the point of sale. Buy now, pay later, I was really surprised, is least preferred, mentioned by just 6% of travelers. The next lowest being digital wallets.
Huh.
Yeah, I was really surprised.
I wonder if that's just more of, I wonder if that's more of just as far as digital wallets, I wonder if that's just more the level of acceptance. It's just not.
Yeah, that's what I'm thinking. But the buy now, pay later, I thought that they had really been kind of growing in acceptance. I know you and I talked about that for some of our plans that we've used.
Right.
Buy now,
that's
pay
interesting.
later.
Yeah.
Payment fraud is a big problem, especially among younger consumers. Industries with high average transaction values like travel already struggle with fraud and chargebacks. So there needs to be more attention to understanding what travelers want to see when planning their trips. 80% of travelers are at least somewhat concerned about the potential for payment-related fraud when traveling. And I don't think that's the pickpockets. I think that has to do with,
For sure.
So robust payment acceptance options and simplified booking processes create more happy consumers. And I know that for a fact. I've been planning a couple of trips, and it's really a pain going from site to site and comparing and all that. And here's something that I thought was really interesting. Cash continues to be important for travelers. About half of travelers plan to use cash for purchases while on vacation.
Hmm.
Now, I think that ties into the debit, using their debit cards at the ATM to get local cash
Sure.
for
Yeah.
their out-of-pocket expenses.
Yeah. And
But all
I was gonna say, I
So-
think there's kind of like a weird component of like when you're traveling, especially somewhere where you're not very familiar, where
Mhm.
there's a trade-off. You don't necessarily want to have a bunch of cash on you, but at the same time, you do want some cash because what if
Right.
your card just doesn't work there, or you just don't know, like what you lose your
That's
phone
the
and
question, you know? I mean, I know, and I've been in Europe, there's been a couple times when my card just doesn't work there.
right, and then you're like,
Have
well,
to
at least I got this money, I got this
At least I
cash,
have these francs or,
right,
lira or whatever
right,
that I keep in my pocket just in case.
right,
And in fact, I was laughing. I was doing some cleaning the other day, and I had lira, I had the Mexican currency, I had some
right,
euros, you
right,
know, just what you come home with, right?
right.
But I do think that, we are finally kind of coming out of that doldrums of travel, and we're seeing a lot more travel, which is going to, portend for a lot more credit and debit card spending.
Yeah, I like it. Yeah, good stuff. And I think for our audience too, it's like, okay, number one, think about your merchants. Are they taking travel payments, payments of people that are traveling? Maybe it's a
Right,
restaurant that's in a travel type area. Being aware of that, being aware of the international assessment from the card brands. I can't tell you how many times, Patty, I've had somebody reach out through our ISOAMP business and say, hey, they're marking it up, 80 basis points or whatever. And it's like, no, they're not. That's the international assessment. Um,
right,
so, understand that part of it. And the other thing is maybe you start going after some of these businesses and understand that, hey, you can bring studies like this and say, look, people want more payment options. They want a robust
right.
payment solution. You need to work with us so we can, improve that experience for your customers. So those are all really valuable things we can implement.
Yeah, and especially for those that are that are selling in touristy kind of
Yep.
areas,
Yep.
Florida, New York, Washington.
Right. You need to be aware of these trends.
Yeah, you really do.
Yeah. Good stuff. Well, thanks so much,
Yeah.
Patty. Appreciate it.